Federal Reserve rate hikes are off the table for July. At least that's what the market is saying right now. Traders who bet on the direction of interest rates are pricing in a very low probability that the Fed raises rates at its upcoming July meeting. That signal comes from federal funds futures, contracts that let professional traders position themselves based on where they expect interest rates to go. When those contracts show a low chance of a rate move, it means the weight of market opinion does not expect the central bank to act. That said, these probabilities are not guarantees. They shift fast when new economic data hits, and they reflect the current moment, not a locked-in outcome. So why is a July hike seen as so unlikely? The short answer is that the data has not made the case. A rate hike from here would require clear evidence that inflation is picking back up in a serious way. That evidence has not emerged. Inflation has fallen considerably from the peaks it hit in the aftermath of the pandemic, and while it has not yet returned all the way to the Fed's 2% target, the trend has been in the right direction. Fed officials have been consistent on this point. They want to see more sustained progress, not just one or two good readings, before they make any further move. And that patience cuts both ways. The Fed has been just as cautious about cutting rates as it has about raising them. Officials have said repeatedly they do not want to ease financial conditions too soon and risk letting inflation come back. So the central bank is holding. And for now, markets believe it will keep holding through July. What could change that? Incoming data. Between now and the July meeting, traders and analysts will be watching two sets of numbers closely. First, inflation readings, particularly the Consumer Price Index, which measures what Americans pay for everyday goods and services. Second, jobs figures, which tell the Fed how much pressure is building or easing in the labor market. A strong surprise in either of those reports could quickly reprice what the market expects. History shows that Fed expectations can flip in a matter of days when the data is unexpected. The current calm consensus could shift fast. The practical takeaway: keep the calendar in mind. The inflation and jobs reports due before the July meeting are the ones to watch. If those numbers come in hotter than expected, the low probability of a hike could rise quickly, and markets across equities, bonds, and currencies would feel it. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.